All right, good morning all to agents. This is Kevin Lauren. I'm the Director of Training and Marketing. And today we're going to be going over some compliance stuff. We're going to be joined by Lauren Nowak and Bill Seitz, and they're going to help us out with a few things. But before we get into today's presentation, I will bring on Cameron Alley from Clearview Mortgage, and he's going to bring us up to speed with what's going on in mortgage land. So let me bring you on. Good morning, Cameron.
Good morning, Kevin. How's it going?
Very well. How are you today?
I'm doing good as always. Hanging in there.
Right, perfect. And I will also bring Bill on in case there's anything Bill needs to say. Good morning, Bill.
Yep. Good morning, Cameron. Good morning, Kevin.
All right.
Good morning, Bill.
Good morning, Cameron. Happy Wednesday.
Happy Wednesday. All right. I guess we'll go ahead and get started with this market update here. So I got a little bit of an update as far as like what the Fed is doing, and then also a little advice as far as, you know, what to kind of talk to your clients about with the market and why it's still a good time to buy a home. Because obviously with the inventory where it's at, it's still a really good idea to get in there and get a home. So basically the 10-year treasury has gone up by 24 basis points in the past 5 business days. That's obviously a pretty big increase. We're sitting at almost 2.6. We were above 2.6 this morning, but it did come down a little bit. So as we expected, obviously rates are going up, and we're just going to have to deal with that. This is the first rate hike of 2022. They're expecting anywhere from 3 to 6 more this year, and then a few more the next year. One of the things that basically Chairman Powell was saying, who's the chairman of the Federal Reserve, in his address to Congress, this was kind of surprising. He said even geopolitical curveballs such as war or, you know, what's going on in Ukraine or Russia or other conflicts will not affect their decision on rate hikes, which is really unprecedented because usually geopolitical issues are the #1 factor when it comes to like interest rate decisions. And usually when something like that's going on, they definitely buy up bonds, which ends up bringing down rates. But with the past 3 years of you know, stimulus and what we had to do to get through the pandemic, they really just don't have any choice right now but to try and ease inflation with the rising of rates. So, you know, basically we'll see what happens. He said that really the only determining factor as far as not increasing rates as much as they wish to would be if it affected the economy gravely. So we'll see what happens, and hopefully we won't see a downfall in the economy. But if it does happen, then we will see rates probably start to tinker down a little bit. But obviously this is part of the process. And you know, for people who have been in the industry for a long time, we know there's up and downs with interest rates. We just had 3 years of interest rates below the benchmark point of like 3.5. So that's really unprecedented as well. So we're, you know, we knew it was going to happen. We'll just have to adjust. But many of your clients who've been actively shopping for a long time and haven't like had an offer accepted, they'll be pretty surprised when they see what their new potential payments will be. But one of the things that obviously we always need to reiterate to people buying a home is that their mortgage payment is not locked in forever. Obviously, rates will go down again. And when that happens, they just need to take advantage of refinancing. And but unlike rent will always go up, but your mortgage, the more payments you make, and if you time it right, you can obviously bring down the payment significantly. So let's say, like, you know, an interest rate drop of, you know, let's say 0.5% when you've been in that mortgage for 3 years and the mortgage is about $600,000. You're after 3 years, you're going to save $500 to $600 on your mortgage. So that's something that you can always let them know that they're not going to be stuck with that payment forever. And also some interesting data I was looking at. We all know that new home builds is one of the issues that we're having right now, and that's why inventory is so low. So they are talking about trying to find a solution for that, which obviously if we start building a bunch of new homes, this is going to fix all the inventory problems. But as far as the numbers, it's pretty crazy to look at. In the 80s, 12.4 million homes were built. In the 90s, 12.4 million. In the 2000s, 14.5 million. And 2010 to 2020, 6.9. And so far since 2019, we've built 250,000 new homes. So pretty obviously huge demand for new home builds there, and hopefully we get that figured out, and it'll ease up a lot of these tensions on the market and bring some new availability to home buyers who want to buy a home. And then as far as a couple updates for Clearview Mortgage, United Wholesale Mortgage, who obviously is our largest and fastest lender, just dropped their minimum credit score requirement for conventional loans to only 620. So that is a cut of 20 points on their credit score. So, but we see a lot of people in that 640 to 620 range that couldn't qualify for conventional loans quite often, but now they can. And this is obviously our quickest and most efficient lender. So that gives us a really, really good option for people in that credit bracket that we had to take to a little bit slower or worse lenders with worse rates. So that's going to help out a lot. They also increased their rate ranges, which gives us the ability to get more lender credit for your clients that are looking to do a very low cost purchase transaction. So we could basically get the loan costs covered, and then they just have to pay, some of the title and escrow fees, et cetera, et cetera. So that's a really good news. And then they also improved their jumbo products, conventional ARM products like adjustable rate mortgage and FHA loans by 80 basis points. So that's a huge improvement on pricing. I did just price up one of those, and it's about a quarter better interest rate. So that's a huge upside to a day when rates should be going up, and they actually went down on those products. But that's pretty much all I have for today, unless Bill wants to add anything to that. But well, you got anything, Bill?
Yeah, that was a very thorough update. Thank you, Cameron, as always. I just noticed as you were speaking, we did go over 2.6.
Yeah.
If you look at the tenure, it's pretty funny how it changes every couple minutes sometimes.
Yeah, and another thing to keep in mind too, guys, is that the bond market is not only determined by the Fed and what they say. If there's big, banks and people who want to come in and buy bonds, rates can still go down, influenced on who's purchasing and selling bonds. It's not always just the Fed who decides, well, this is where rates are going to be. So you could see, rates come down a little bit, and we just don't know. It's one of those things where there's no crystal ball, but the trend is definitely up. And now it comes down to timing your lock and making sure when you get into escrow, you get that thing locked as quickly as possible.
Yeah. And to add to that, Cameron, I know, at this point, just seeing how quickly the rates have gone up in the last, they've gone pretty hard and fast on this thing. And I noticed on the market report this morning, just the language from the Fed is that they are going to continue this even quicker. So the market is reacting to that. And I know also I talked to our wholesale rep at United Wholesale yesterday, and he said that they've now touched 6% on their pricing range on mortgages. So, on their pricing sheet, they have a range that they're offering out to the wholesale brokers, and the top end of that range has now touched 6% for the first time. So we're really going up quickly. And I think the glue to keeping this market from softening is the lack of availability. It's scarcity on the listing side. If we had a ton of sellers right now, I think you'd see prices coming down and the market would be softening. But since supply and demand is overweighted to the supply being very low, you're still going to have a strong housing market as far as prices going up and multiple offers. But we'll see how long that does last. And ultimately, if you have sellers on the fence right now, and this is something you could even take off of the CNBC web, front page of the financial link there. And I think they talk about what the Fed's doing and what's happening with mortgage rates. It's a really good tool to tell your clients, look, this is happening. There's a good chance there could be some softening in the future. If you want to sell, let's take advantage now. Let's get this thing on the market and get you top dollar.
Yep. Exactly.
Well said, guys. I'm actually looking forward to going back and listening to that again in the replay, Cameron, because that was a lot of really good information.
Yeah, I try to make it quick, but yeah, you can always listen to the replay, and that'll help you. I don't want to take too much of your time, but there is a lot of really good info there.
Yeah.
And obviously, what we hope is that they start just building a bunch of houses, because that would fix 50% of the problem. But we need to get the supply chain issues worked out, and then hopefully we'll have, we could easily have another housing boom if they just start building houses. So,
Okay, good points. All right, cool. Well, thank you very much for that. Much appreciated. Of course, anybody that needs to get a hold of Cameron, you can go to CameronAlley.com, or you can go to clearviewmortgageca.com, and you can contact any one of our loan officers. All right, perfect. So now we're going to switch gears. We're going to bring Lauren Nowak onto the line. Lauren, can you hear us? Are you there?
Yes, I can. Hello, everybody.
All right, good morning, Lauren. So Lauren and Bill are going to be going through, and you should be able to share your screen. Let me stop my screen share. So yeah, you should be able to share your screen, and Lauren and Bill are going to go over some compliance stuff. Keep us all in check, right?
Yeah. Good morning,
Do our
Lauren.
best. Hello.
I'll just kind of start here real quick, Lauren. As everybody knows, Lauren does our compliance and file review, and she's also a CAR certified forms trainer. Also a licensed, licensed with the DRE, and so she's a great tool and asset for the company in so many different ways. And when I work with her during the week, signing CDAs and going through different things with her, and getting questions from her on some things, we've noted there's been a few things that I think need to be addressed, just for overall knowledge, and also just what the expectation is on certain requirements. And we have a small list this morning, right, Lauren, that we've put together.
Yes.
that I think will be helpful to everybody. And this is just something that we all need to continue to learn about and do our jobs in, as it's intended by what the California Association of Realtors and their attorneys and best practices, want the licensees to operate in a certain fashion when it comes to some of these things. So, Lauren, I'll let you pick the topic that we're going to start on. I think we have about 5 or 6, maybe 7 things that we're going to address, and we won't, bore everybody, but we'll go through them fairly quickly. But
Yeah.
let's get after it.
I think, like Kevin said, it's a really good idea to go back and rewatch this webinar a couple of times if needed, because the things that we're going to touch on are not really a big deal until they're a big deal. And so they're things that are commonly overlooked or misunderstood until it becomes a lawsuit, and then you wish that you understood this information. And so the biggest thing that we're seeing kind of compliance wise that wouldn't necessarily be something that the agents are that you're used to seeing, because this has to do with the new purchase agreement. And so let me see here. Are you able to see, which screen did I share? Hold on here.
You see the CAR homepage.
Oh, perfect. Okay, we'll try it again. There we go. That one. Okay. So the first one that I wanted to talk about is the newer one, and that's DEDA, or delivery of, or designated electronic delivery address. And that comes from page 16 of the new purchase agreement. And let me just scroll to that real quick here. And this is the section that, if you guys remember when I was going over with teaching about the new contract, the CAR attorneys felt like this was the spot that was going to trip up most agents. And it's this section on the last page of the contract of the RPA. And it is this designated, well, you're not going to see it here, but designated electronic delivery addresses section. So previously in the old contract, all of this stuff would autofill. It would put your address, your phone number, your email, blah, blah, blah. The reason that this is brought out and made in its own section is because of the changes in the new purchase agreement relating to definitions of delivery and definitions of days of when something is received. This is for notice to performs. This is for contingency removals. This is things that are time sensitive. And so it's important that the definition in the contract, when it talks here about what is delivery, it talks about the designated electronic delivery addresses specified in the real estate broker section on page 16. So it's really important that this section gets filled out. And a lot of times it's not. And this is an issue for a couple of reasons. One, let's say, for example, you go on vacation and you're in the middle of a transaction and the listing agent has a better offer waiting in the wings and they're trying to get rid of your buyer, and you go on vacation. Maybe there's a time difference. Maybe you're on the plane. Maybe you don't have access to your emails like you normally do. And the agent sends a notice to perform and you don't see it or you don't get it. Or there's no email address on here. Maybe they went to your website. Maybe they went to LinkedIn or Facebook and they found an old email address and they sent it there. That counts because there's nothing on here that specifically says, this is the email address I'm using for this transaction. This is how you can electronically deliver notices, documents, information to me about this transaction. There are also certain elements that can be delivered, or notices that can be delivered via phone or text message as well. So that's why there's that text number there. The other thing is the option for an alternate email address. So if you use like offers at realtor.com, and then once you go into escrow, there's like an alternate email address. You can put both of those email addresses. You can then also check the box that says only use this email address. I had a team I work with once that made an email address for every single transaction. Only send communications to this email address. And if the listing agent sends this notice to perform to something other than what is on there, then it is a disputable form of delivery. It's not technically delivered. Okay, so this is super important. So when it's not done, the other thing to note is that the agent, this is the sample form, the updated version has text on here that says this section on the listing side needs to be completed by the listing agent. So it's not, when you're filling out the offer, it used to auto-populate for both sides if you linked it to the MLS. Doesn't do that anymore. Shouldn't do that anymore. The listing agent needs to say, this is how I want to communicate. Or if it's not correct, then you as the listing agent need to correct that. So how do we do that? There is a form for that. CAR realized pretty quickly after releasing this contract that they needed a form to fix it. It is the DITA form. It is what it sounds like, the designated electronic delivery address amendment. And this just is that section on a separate form. And it says that here's, for either the buyer's agent or the seller's agent, here's all the information, and everybody acknowledges a copy of receipt. So keep that in mind. These are things that are going to be asked for in compliance reviews more and more. This is something that you need to be filling out in your contracts, because it's really important later on down the road, if there is a lawsuit, to be able to go back and track that. So
Yeah,
do you have any questions on this?
That's a good one, Lauren, because you can't say, no longer can you say, oh, I didn't get it, or you can't plead ignorance anymore. So
right.
You might as well get the best contact for yourself on this thing, so you can avoid any issues with that. Because right. we all know how agents get with the notice to perform, or contingency removals. Well, I never got it. Oh yeah, it went to my junk email. It's in my spam. Well, yeah, it's on you.
Yeah, exactly. And like I was saying before, if you do go on vacation, or if there's a family emergency and you have to leave town, and you have your colleague in the office is, hey, they're going to be handling this paperwork for me, use this form. Change the designated delivery address to the agent that's helping you out. And then when you get back from vacation, or you're ready to take over the file again, use another form and do it again and change it back to you. It's important to keep this information documented and correct, because again, it seems trivial. We're all in communication and we text and whatever, until there's a lawsuit, until somebody gets angry, until there's some sort of conflict. And then these tiny little things come into play and are a really big deal. Okay.
Cool.
Yeah,
So
no, Nora, I really like the way that you phrased it. It's not an issue until it becomes a big issue.
exactly. Exactly.
Simple.
Yeah. And these are all kind of things that it's like you don't realize it. And a lot of it has to do, like the next topic that I'll touch on, it has to do with things that used to be an old way of doing things, and now they've been updated, but the standard practice, or the how people are in the habit of doing things is still the old way. And so it's important that everybody gets updated on it. And this one that I'm talking about is the FERPTA. And it's quite a mind bender. And so it's definitely a section that I recommend everybody goes through and kind of rewatches and tries to absorb to get all the information in front of themselves as best as possible. The FERPTA form, this used to be the form that CAR had was not considered complete unless the seller had filled out their social security number. And so this form since then has been updated so that the default on this form is that the seller is telling the buyer, I've provided this information to escrow, to title, to what's called a qualified substitute, and they have that evidence on file, and they will provide you with a form that says, yes, they have it. Okay, so why is this a big deal? Pause to kind of jump over to a function in CAR that is extremely helpful, that I highly recommend. When you log into car.org and you go up to Transaction Center and you go over here to Risk Management, there is a section here called Legal Tools. And these legal tools are basically quick guides, which is like a one-page summary guide that brings a lot of kind of common questions and terms and issues into really layman's terms, easy to understand, easy to digest. And so one of the examples here that I will is this one-page FERPTA guide. And I'll just pull it up here because the way that they explain it is a lot easier than me trying to re-explain it to everybody. But the biggest thing to know is that basically, if the seller is a foreign entity, it is the buyer's responsibility under federal law. A buyer of real estate is obligated to withhold 15% of the purchase price and forward that amount to the IRS if the seller is a foreign person. Not escrow's responsibility, not title's obligated, the buyer. This is your buyer's responsibility. The law applies to all sales of real property in the US, residential and commercial, whether maintained for personal or investment. So this is very few exceptions to this sort of thing where this is required. The withholding amount is reduced to 10% if the buyer will be an owner occupant and the purchase price is $1 million or less. Great, fine. A buyer who fails to withhold this amount when required may be liable for the amount of the tax plus interest and penalties if the seller is a foreign person and does not pay the taxes on the sale. What does this mean? This means that if the buyer purchases a home and they don't get evidence that the seller is exempt, and it turns out that the seller is a foreign entity, and the buyer does not provide these funds to the IRS, the buyer is liable. The buyer has to pay that money plus interest because the seller's foreign, they're long gone. So, oh my gosh, this is a really big deal. We are so used to escrow doing this for us, but it's not always the case. And it's actually a lot more common than you might think. So how do we around this, right? So there are exemptions. The buyer doesn't need to withhold this money if one of the 4 exemptions applies. One, there's a buyer affidavit. Okay, so if the purchase price is less than $300,000 and the buyer is not occupying the property, they can sign this buyer's affidavit. They don't need to worry about it. They don't have to collect the funds. There's a CAR form for that. Number two, the seller's affidavit. The seller provides an affidavit to the buyer asserting the buyer is not a foreign or the seller is not a foreign person, and the affidavit contains the seller's social security number or taxpayer ID. So you can do that on the AS form. There is a section here where you can check the box to transfer the required information. Seller can give it directly to the buyer, fill out this information. That's all that's needed. 3, a qualified substitute. Instead of providing the buyer with an AS form, which includes the seller's tax ID or social security number, the seller can provide a completed affidavit to title or escrow, who in turn provides the buyer with an affidavit affirming the qualified substitute is in possession of the seller's affidavit. Or you can go to the IRS and get a withholding statement, but everybody very, very, very rarely does that. Okay, so the most common practice here is item number 3. The one thing to keep in mind is that what I hear, what is kind of the common practice when we request this document or this information from the listing side is, oh, escrow will give that to you at closing. You'll get that in the closing package. Okay, here's where the issue is. I apologize if I'm barreling through all of this. It's a lot of information. The withholding requirement is a statutory disclosure. And I'm pulling up the purchase agreement here on page 8 in section 11H. The contract default says buyer and seller instruct escrow holder to withhold. Let me zoom in a little bit here. Here. Buyer and seller hereby instruct escrow to withhold the applicable required amounts to comply with federal and California law, blah, blah, blah. So it's written into the contract that escrow is required to withhold the funds. The buyer is telling escrow to do it on their behalf. And then escrow, the seller will need to provide the FERPA, and then escrow will provide a QS either on the CAR form or their own CAR form version. Okay, so that's the first thing to keep in mind. This is a statutory disclosure. It's required to be delivered the same time as the TDS, the SPQ, this information, whether it's from the seller or from escrow. So it's a requirement for delivery. Can't wait until escrow closes. The other thing to keep in mind is that not all escrow companies or title companies agree to be a qualified substitute. And so I wanted to show a couple of examples of the FERPA form, some things that get uploaded as evidence from escrow that are not actually the correct kind of form. This form is from lawyer's title. Here it is regarding the FERPA. Here's some information. Buyer signed it, seller signed it. This is just an advisory. This is just a notice. And in fact, in the form itself, it says that lawyer's title will not act as a qualified substitute. They won't file the tax forms with the IRS. They're not responsible for collecting or holding the social security number, any of the information on the buyer's behalf. So if for some reason the seller on this transaction actually was a foreign entity, this would completely be on the buyer. Another example is something that looks kind of like this. Again, for your information. This is, again, just an advisory. So the thing to remember about this, the first example here of them saying, even though it's in the contract, right? The escrow instructions, the purchase agreement itself is also escrow instructions. But a lot of escrow companies provide their own set of escrow instructions, which reiterate or amend those specific elements to protect or comply with that escrow company's policies. So even though it's in the purchase agreement, in these escrow instructions, they are saying this is basically overridden. We're not going to do that section. So buyer beware. This one doesn't say that they won't do it. It just says, here's information on it. Who is the seller and what are you supposed to do? And here's basically that quick guide, but on escrow paperwork. The reason that you need something different, which I'll show you a correct example, is if for some reason the IRS comes and says, hey, we think the seller was foreign, where's our money? the buyer provides them with this documentation. No, the seller signed an affidavit. No, escrow said that they had this information. Escrow said that they confirmed it. This document would not qualify for that. This document would not qualify for that. Something like this, however, would. This is the escrow agent's statement of receipt of the FERPA status. And so it says here, these are the escrow officers. We are an employee. We are a qualified substitute. We have this information and we signed it. Great, this is what you provide. Now we don't need anything in the file with the client's social security number. We don't need, the AS form. We can use the QS form, or you can use the AS form without the seller's information on it because they're saying we gave it to escrow. Okay, so then the other thing that I see too on this, the QS form, which is what can be provided in lieu of the seller's affidavit, is agents will say, well, listing side will say, here's the form, sign it like this. No, or sign it and send it to us and we'll have escrow sign it. No, this is a disclosure that needs to be provided by the seller on the listing side with the disclosures. It doesn't go on to the buyer to sign a form that hasn't been signed by escrow first. That's not how that works either. So this is something that is very intricate and serious, but something that it takes a little bit of understanding and kind of mapping out to really grasp. Because if the IRS comes to your buyer, guess who your buyer is going to go to? And everybody's not going to be happy. So this is a habit that has to break. This document, this information needs to be provided within the initial time frame for disclosure delivery. And it's important that you guys understand why and why it's important and how to protect your client. Any questions on that? Okay.
That's the fun one, Lauren.
Yeah. So, okay. So what else? Let's see. Let me pull up here. We also wanted to talk about another, I guess, a side note to it when we're talking about disclosures, to keep in mind that it is a requirement for agents to do a visual inspection. It's our office policy that you do an avid on every transaction. And also keep in mind that if it's a multi-unit property, up to 4 units, we need an agent visual for each unit. You have to visually inspect each unit. That is the requirement. If it is a property that's in a different area, excuse me, we've got tons of agents all over, and you can reach out to one of them if they're under the same brokerage, maybe have them visit the property. That's okay, because the visual inspection is done on behalf of the broker. And so if a salesperson that is under the same broker does the agent visual inspection, then that's acceptable. So, oh, it's a property that's up north or down in Southern California, I can't get to it. You still need to find a way to get an agent visual inspection done. So keep that in mind. And then one of the other quick guides that is really helpful in here is talking about the appraisal contingency. And we've had a couple of questions and things come up in regard to this, and also how it relates to FHA appraisals. But this quick guide is really, really helpful in learning how to change that appraisal contingency. So a lot of times you'll get a contract where the buyer says, buyer will pay $10,000 over the appraised amount. And this is an issue because at first it seems straightforward, but it can be interpreted a lot of different ways, right? And this quick guide kind of goes over the different ways that it can be interpreted. And so the best way, it tells you right here how to do it, is to be as specific as possible. This is the right way to to amend that contingency while still kind of trying to give your buyer that edge of like, we'll go even higher, you know, but you also want to protect the buyer as well. And then, you know, when you have text like this, the issue can then also affect whether or not it changes the purchase price. So, you know, if we had this example recently where there was a clause like this that was written in, and the agent capped the appraisal amount at the purchase price, but there was no cap for how low it would go. So they said, oh, well, we'll pay, I don't know, it was like $10,000 or $8,000 over the appraised price, but up to this dollar amount. Well, the appraisal came back at 20,000 lower than the purchase price. So the buyers assumed, well, we'll pay 20 or we'll pay 8,000 over that appraisal amount, and that'll be the new price. And the seller was like, no. And so it created this confusion and this ambiguity because it was interpreted in two different ways. And it can be an issue. So it's really important, I say all the time, the biggest weak spot is when agents have a field that they can just fill out all by themselves. When you guys start writing in terms in contracts, it can get really sticky. And so it's important that you reference the contracts as much as possible, that you're as detailed as possible. And I don't know, Bill, if you want to speak on this any more specifically. I think
Yeah, well, so this is a real transaction that's going on currently. And actually I have to get on after this webinar. I'll have to talk to actually the brokers are now involved. So this was a very vague kind of addition to the contract. And it doesn't say explicitly that the seller is going to accept that that term. It just says buyer to pay, you know, is $7,000 or $8,000 over appraised value. Well, that's very, very weak in language, and it can be interpreted a number of different ways. And so now we are at the point where seller doesn't want to move forward with this buyer because it's coming in, over $10,000 below what they had agreed upon. And the buyer's agent is now posturing and saying, well, you agreed to this, and even kind of admitting the language is weak, but we're at a stalemate. So this is where we need to be very clear on what the obligations are of each party. And so just keep that in mind. You know, if you want to avoid this stuff, and especially nowadays, I mean, I know we're going to get into some other things with the appraisal, I think here, Lauren, when appraisal contingencies and all these things or escalation clauses are being written into these contracts, it gets very delicate.
Yeah. And there's also a quick guide for escalation clauses. And there's even a little slide deck. But this is the same thing where it will tell you, you know, and the escalation clause that gets written in is, you know, oh, we'll go 5,000 higher than the you know, highest offer or whatever. And so this is where you can kind of get into trouble. And so it explains really well what the issues could be, and the proper way to go about doing it. And so it's important to keep in mind when you're writing these contracts and when you are receiving these contracts, because everybody was worried, you know, had there not been this clause in there, the transaction is an FHA transaction. So that is sort of the next thing that we'll go into, because it has its own protections as far as the appraisal goes. But the way that, you know, it's because nothing was written in as far as affecting the purchase price, or agreeing to adjusting the purchase price, the typical protocol would be the buyer and seller agree on a sale price, the appraisal comes in lower. So unless there's terms in the contract that says, oh, buyer, regardless of whatever the appraisal is, the buyer will fill the gap, right? And so sometimes the buyer can't. Sometimes the gap is so big that you need to renegotiate the sale price. And the buyer will either pay the agreed upon contract price, the sale price, or they have to ask the seller, hey, can we renegotiate? We'll split the difference. Or, hey, we only want to pay whatever the appraised amount is. This is still another point of negotiation. And if the seller says no, the buyer can cancel. That is the appraisal contingency. There is nothing in the contract that says, well, too bad, seller, now you have to sell it to them at this low price. There's still that point of negotiation. Now, for FHA transactions, there is this element additionally reinforced. And the contract, the FHA FVAC form, this amendatory clause, even if the buyer has removed their appraisal contingency, and even if they removed it with the offer, or even if they removed it within the process, if the FHA approval appraisal does not come in at value, the buyer can still cancel based on that, even if they've already removed their appraisal contingency. So this buyer, in this case, their options are to either pay the difference, or to come to an agreement with the seller on this purchase price, or cancel. They don't have to buy this property at a price that they're not comfortable purchasing it at. And even if they had removed their appraisal contingency, which they hadn't, then they could still cancel based on this specific clause and this element, because it is an FHA transaction.
Yeah, and I just want to reemphasize, if everyone heard that clearly, even if you submitted an offer removing the appraisal contingency, if it's an FHA or VA, right, transaction, appraisal doesn't come in, you still got an out. So if you're a seller thinking, oh, I accepted this offer and there's no appraisal contingency, well, that basically doesn't mean anything.
And it says here, right here in the contract, if you check the no appraisal contingency box, removal of appraisal contingency does not eliminate appraisal cancellation rights in the FVAC form, which is why it's so important for this form that you have it where the price is the actual sale price of the transaction, not that initial offer price. If you guys change the price in negotiations and it's now higher, you should get another FVAC form. And it says right in here, if after signing the clause, the purchase price increases, buyer and seller agree to sign before close of escrow a new clause that reflects the final purchase price. So this form in this section should always have the current final sale price in it, so that you're protected by this element in the contract for the appraisal contingency for FHA loans.
We got a couple questions here, Lauren.
I bet.
Yeah. So I just want to go back real quick to the Avid topic. So Tom Lou asked, so if the property has an ADU unit, will we need a separate Avid?
No, because there's a section, I think the Avid has a section now. It's kind of considered, it's all part of that kind of property. I think that's probably still a gray area and a good question. So I'll have to look into that more and get back to you. But I would say no, I would just fill out the Avid and say the ADU section where it says other, you would fill that part out too.
Yeah, I think I mean, it's not going to hurt if you did an extra one.
Yeah, exactly.
And it's not going to hurt. But at a minimum, I think if you put in the other area and specify ADU, inspection noted these items or whatever, at least you're acknowledging it and addressing it instead of, kind of not having that in there.
Yeah. When in doubt, disclose.
Always. Okay, was there another one here? Blah, blah, blah. Oh, and the other question was, do you still have an out for a conventional loan? I think that FHA VA mandatory clause is very specific to those two loan types and not conventional loans, unless you know something that I don't know, Lauren.
Well, I mean, there's the section here where you can also write into the contract appraisal contingency based on appraised value at a minimum of the purchase price, or and so this is kind of where you want to get educated on escalation clauses and also amending that appraisal contingency. There are pros and cons for filling in a specific number there. But in the case that we were talking about, it did have those kind of two protections because it was the FHA. So if you had removed your appraisal contingency on a conventional loan and the appraisal came in low, you would not have cancellation rights based on the appraisal.
Right. And I think that's what he was referring to. So
Yeah.
Conventional loans don't have their separate protection. I think the reason they do this is because FHA and VA loans are insured by the government. So they're kind of their own little section of, just like appraisals have to have certain things, for FHA and VA loans, like termite for VA, and you have to have appliances and utilities need to be working and stuff like that. For government stuff, it's a little stricter, and there's a little more just a little more structure and requirement in place for that.
Yeah. And the other thing to remember too is if you have a conventional loan, you have an offer where you remove the appraisal contingency and then the appraisal comes in low, you cannot cancel based on the loan contingency. You can't say, well, now I can't get a loan because the appraisal came in low. That's the appraisal contingency. So if the appraisal came in at value, then and you were still able to go forward with your loan, right? So the appraisal is approving the house, the loan is approving the person. So if you were still able to get the loan, the only difference is the appraisal came in low, then you cannot cancel based on the loan contingency.
Yep. And also I want to just note this, a lot of agents, when they fill out the contract, they don't put in an interest rate
Yes.
for, basically a criteria point. And this is a huge one, especially right now with escalating interest rates. If you don't put in, that interest rate of where they're pre-approved at, you're kind of leaving yourself open. And this is an additional protection for you and the buyer, because if they were pre-approved at, let's say, 4%, and now they can't get a loan for 5%, but you don't put that in there, you don't have that extra out now.
Yeah, exactly.
So make sure you know what that interest rate is and where they are pre-approved at, and how impactful it'll be if it goes up, because we're in a very uncertain market right now as far as financing. So you really got to pay attention to that.
And we kind of touched on it when we were going over this section too, but it's a very tricky section in the contract, because where this box is placed, it makes it look like the interest rate is a fixed rate or initial adjustable rate not to exceed blank percent. And that's not the case. It's either a fixed rate or an adjustable rate. It's either a fixed rate not to exceed blank percent or an initial adjustable rate not to exceed blank percent. Does that make sense? So the not to exceed section should be filled out regardless. It's just if the default is that it's at a fixed rate. And if you want it to say this is an initial adjustable rate, then you can check that box. So
yeah, and I think for most transactions, obviously there's the exceptions, but you probably want to have a fixed rate in there just for your protection.
Yeah.
A couple more questions from John Espinoza. He says, I also understand if the FHA appraisal falls short, the seller must now consider if another FHA offer is presented, it can make a difference to the seller regarding the appraisal, ?
as far as they would just use the same appraisal for a second FHA loan,
Let me see.
or
Understand.
just going to scroll through here to the appraisal section real quick.
I'm just trying to understand what John's asking here. I also understand if the FHA appraisal falls short, the seller must now consider if another FHA offer is presented, it can make a difference to the seller regarding the appraisal. Well, I think maybe he's referring to having another FHA offer. If something falls through on the first appraisal.
Yeah, I mean, I think that would apply regardless. And there is a section in the contract that talks about when the appraisal is to be delivered to the listing side. You know, even if you had a regular loan that had canceled because of a low appraisal, you know, that information is now material. If you receive a copy of that appraisal report, that is material information that should be disclosed to the next buyer. And if the buyer is canceling based on the appraisal, the seller has the right to request a copy of that appraisal report. So it's not automatically delivered, it's upon request. And I feel like there's an exemption for FHA. I have to go back and look.
And then here's another question.
But
Even though
anyway.
from Tom, Lou, even if I see an offer remove the appraisal contingency, I notice that the buyer can still get out with the loan contingency, right? Yeah, the appraisal and loan are two different things. So once again, you want to make sure, I think if you're representing the buyer, that you put in the interest rate as another layer of protection. And if you're a listing agent, you need to be very aware too where the market is, because if somebody puts in 3.5%, let's say in a high balance loan or a jumbo loan, well, pretty much I can tell you right now, there's very few, if any, banks right now offering 3.5%. So they've got their out now.
Yeah.
If they can't get a loan for 3.5%, even though they've removed their appraisal contingency and they've removed everything else but this loan contingency, they're still going to have their out. So, it's a very tricky market right now. You got to understand all this stuff.
Yeah. And don't be afraid of counter offers, guys. For some reason, they're like starting to get this bad rap. Agents are like, well, we have these 16 pages of the contract. I don't want like extra paperwork. And get detailed on the listing side. Go through and fill these gaps and fill these loopholes. And, it protects your client, and that's really important. And if the other side gives you a sloppy offer, then that's what the counter offers are for. Go in there and clean it up and do it to protect your seller. Put in a 10% interest rate, or so, like if you're going to leave it blank, sky's the limit. So now there's really no out, if no matter what it comes back at realistically, these details are important. It does say in here too, on the contract regarding the appraisal contingency, the ability to cancel based on measurements provided in an appraisal actually falls within the investigation of property contingency. So if the buyer gets their appraisal back, this is, of course, if that contingency has not already been removed. If the buyer's already removed their investigation contingency and the appraisal comes back with different square footage amounts, they can't cancel based on the investigation contingency. However, the information in the appraisal can be used in consideration of removing the investigation contingency, if that makes sense.
Yes, it does. That's a good point.
This was kind of how our conversation started, of like, and another thing, and also don't forget, and things just kind of domino and expand. But the side note to that is to remember that it's investigation contingency. It's not the inspection contingency. And that is one of those things that kind of the FERPA is just how everybody's done it for so long, but words matter and the definitions in the contract matter. And there is no inspection contingency. There is a contingency that includes elements of inspections. But when you're a listing agent and you counter out inspection contingency to be 10 days, what is that? That's nothing, that could be anything. There's up to 10 different combinations of contingency removals that are in this contract. And it's not just inspection, loan, and appraisal. So keep that in mind. That's a whole other webinar.
Yeah. So if you substitute investigation for inspection, then
yes.
it's more broad-based in encumbering everything under the definition of an investigation. Could be termite, could be sewer, plumbing, could be a roof inspection, could be just the physical inspection or whatever. I think that's a good point to take away from that.
We just had a multi-million-dollar property or escrow cancel because the buyer looked on Megan's Law and was not comfortable with what they saw, which is one of those things where it's like, yeah, it's written in a lot of places in the contract, but people forget to do that. That's part of that contingency. And
did you say, Lauren, that Megan's Law is part of investigation?
Yeah. Right. It's in the buyer
Yeah.
inspection advisory. It's in the contract. It's in the statewide buyer and seller.
Right. So if you're
yeah.
looking at your client's looking at a property and they go on, or they find some information that there's a neighbor that's got a very suspect background, like, oh my gosh, I don't want to be neighbors with this person. Well, there you go. That's investigation.
And the investigation contingency is the only contingency in the contract that doesn't require backup evidence on why you're canceling. If you cancel because of appraisal, you have to show the appraisal. If you cancel because of loan, you have to show that the loan's been denied. If you cancel because your home sale buyer canceled, you have to show that evidence. But investigation contingency cancellation is based on good faith. And that can be, no, we saw something in the listing agent's Avid and we'd like to cancel. That's it. So keep that in mind. The final thing, sorry, did you have something else?
Who, me?
Yeah.
No, we're good. Moving right along.
Okay. The other thing too that I wanted to touch on that was kind of a learning experience both for Bill and I last week, talking about the requirement to disclose offers that you're receiving on your listing and the offer price of those offers. It is written into the contract that if in the listing agreement, sorry, not the purchase contract, in the listing agreement, that the broker is here, the broker is authorized but not required to disclose any real estate licensee making an inquiry, the receipt of any offers on the property, and the offering price of such offers. So if the listing agent feels that it would be in the best interest of his seller, the listing agreement gives the listing agent authorization to disclose offers on the property and the offer price of those offers. The more you know.
Yeah,
so.
this is an interesting one because, I've always, up until recently, always assumed you cannot, it was best practice to not disclose terms of offers that you're getting on a listing. But as you can see, and I don't know if the language has changed recently or it's been in there for a while, but you don't have to, but you can as well. So, I think it's probably good at the time of taking the listing to review both sides of what that means for your seller, right? Hey, if we start getting multiple offers, it might, whatever your belief is on how you want to get, best terms and price for your seller. Are they okay with disclosing offer price, terms, conditions to other agents? Because we had go ahead.
I was just gonna say, maybe the seller is like, I don't want to do 15 counter offers. I just want everybody's highest and best. So sure, tell them what we're dealing with here, especially in this market. Maybe it's like, oh, okay, you know, what do you got over there? All right, mine's gonna be a little bit higher price.
Right. And so we had an agent from another brokerage kind of try to bully one of our agents, saying that they had to disclose the price and terms to this agent. And so obviously we're finding out here that that's not the case. You don't have to, but it's based on really what, you know, seller authorizes you to do.
Yep. And I think that's kind of it.
Yeah, well, that was a nice, you know, 45-minute, you know,
Yeah.
intake of stuff, but it's really good stuff. And, you know, as we can all see, the amount of forms, the amount of, you know, disclosures, the amount of things is always changing, always increasing. It's a very fluid thing, and we always have to stay up to speed on this stuff as we are operating and doing our activities out there.
For sure.
Yes.
Well, I really appreciate you guys going over all that stuff. I also really encourage our agents to watch the replay and to, you know, because this stuff is really, really important. There's a lot to it. And so the replays are a really good resource for this. So don't hesitate to utilize the resource that you have. Also, a reminder, all of our replays are on our YouTube channel. Just go to YouTube, do a search for Alta Realty Group, and you will find us. So you can also follow us and subscribe to our channel, which is also a great idea. That way you get a couple different reminders. So there we go.
Thank you, Lauren, so much for your time this morning. You know, and we'll continue to do this from time to time. You know, as we see other things happening, we just want to keep everybody informed. You know, Lauren's a good person for me to reference things that you know, I may be asking her interpretation on, and vice versa. So we are, you know, going back and forth during the week and reviewing some of this stuff. So we will continue to send this, you know, stuff out as we see fit. And so not every week is going to be a marketing training with Kevin. It's going to be a review and compliance training.
Exactly. Oh, and Tom Lou had one other question too on the listing agreement. He said he didn't notice the designated electronic delivery addresses. And that's correct. You don't need it for the listing agreement, because that's between you and the seller. It's for the purchase agreement, an agreement between the two agents on how they'll communicate and deliver notices and important information. So one final note.
Right. And I get my final note too. I just want to remind everybody that we have moved back to Skyslope. So I think everybody's you know, using Skyslope now. Lauren and Bill, we're not seeing anybody uploading new transactions to .loop, right?
No, not new ones, closing out some final ones in .loop, going through, making sure if you have any transactions in .loop, please make sure you've gone through and uploaded the closing statements and those final items. I know once everybody gets their CDA, it's easy to forget about the file, but there are still some final elements that we do need. And so make sure that you upload those. And we are working to get Skyslope all cleaned up and get a clear procedure and set up for you guys as well. So it's a little bit more clear cut.
Love it. So more to come on that. In that case, agents, thank you so much for joining us. We really appreciate it. We've got a couple of new agents that joined us today. It was nice to have you guys. Tom Lou, thank you for joining in the conversation. And Fernando Avarca. Fernando, I know you and I had a 10 a.m. that, you know, our Wednesday webinar went a little long, so I'll talk to you in a second here. But agents, get out there, make it a great week and a productive week. And we will see you guys on the Wednesday webinar next week. Bye-bye.